Okay, I'm David Wood. I'm Director of the Initiative for Responsible Investment, which is a project of the Hauser Center for Nonprofit Organizations over at Harvard's Kennedy School, across the river from where we are now, and we study responsible investment broadly construed. We do projects organized by stakeholder group, investment consultants, pension funds, foundation endowments. We do projects on issue areas, something like sustainable agriculture or climate-related investment across asset classes. And then finally organized by investment vehicle, typically looking at different asset classes. I do a lot of work on property investment in particular, how you can measure social and environmental performance of investments, but also how you can relate that social and environmental performance to financial return. And one of the issue areas we've looked at over the past few years is corporate disclosure. And in particular, how we can design a corporate disclosure regime that meets the needs of investors and regulators and the public at large by linking corporate performance to its long-term effects on the real economy. So something like sustainable wealth creation over time. And the report we just put out, which is called From Transparency to Performance, is a study of the process by which regulators can come up with a set of manageable key performance indicators across industry sectors so that in the first place, investors can have comparable data on core environmental and social information. We're looking at non-financial information that we think is material to investment performance. But we want to use a broader definition of materiality to understand materiality to society at large. What are material impacts? We don't think at this moment the markets function necessarily to allocate capital to those corporations which create long-term wealth, because we haven't internalized all the impacts that corporations have, positive and negative, on society in the capital markets. And so we decided to put together a process that we thought would give this kind of comparable information that would be useful to investors, but also to third-party reviewers of how corporations are actually affecting the world in those areas most core to their business activity. So we chose to set up key performance indicators by industry sector. That's one cut. You could do it also by size or geographic reach. But we chose industry sectors because we felt that was a clear way to offer comparable data to create a peer group where you could compare apples to apples, but also where you could come up with a core set of a few indicators, something like 6 to 10, that could be mandatory, all the way down to the actual indicator itself, the number or the qualitative data point which is used to generate information for the end user. Along those lines, we came up with a system which is really just a think piece. It's a way to begin the discussion about how we can take the broad universe of sustainability indicators, say, put out by the Global Reporting Initiative, filter it through at this point, rudimentary scoring system, whereby you come up with, for the industry sector, those 10 indicators that seem most important, and then you come up with a system to tailor the actual piece of information that corporations will report. And what we found is that it works. Industry sectors have different indicators. The key to putting this into practice will be coming up with the right group of stakeholders, public, private, civil society, who designed those core set of mandated key performance indicators. Because without a broad collection of stakeholder interests, we'll end up with corporations not reporting on the full effect of the full material effects of their activity. So there's a lot of political work to be done to take a system like ours and put it into practice. But we think it is more likely to lead to, for society, long-term wealth creation, which will lead for investors to long-term sustainable returns. We've seen this high volatility in the markets, to say the least, and the collapse of the global financial system can be linked at the broadest level to the idea that people were trading on bad information that was tied to the next quarter and not to the next 20 years or the next 100 years, and not tied to corporate activity in the real world, but instead of a second order or third order trading between investors. If we have the right information and we have the right incentives for investors, and we have the right watchdogs to make sure the information is good, at least in theory, we should have a market and a set of investors who allocate their capital towards things that create jobs for us with a sustainable environment, within a sustainable environment, and promote the innovation and the activity and the economic growth that can come from the private sector, but tie it more closely to, from the public vantage point, to this long-term sustainable wealth.
David, what sort of emerging issues then are people talking about here at the moment in regard to this?
In regard to investment generally, and not just indicators, well, I think we have a growing community of people who've signed on to the principles of responsible investment, who have agreed to incorporate environmental and social governance information into their investment analysis. They have agreed to be active shareholders for public companies and file shareholder resolutions, and they're just beginning to put these systems into practice. And so we have, it's not even a growth industry yet. It's really first steps in how people can incorporate what they take to be long-term material trends, but into their investment decisions, into a system to measure success. At the moment we have benchmarks which don't incorporate this sort of information. So how do you properly identify what comes out? I think there's a lot of thinking going on right now about how to manage those kinds of initial steps to engage in ESG analysis. Beyond that, we're seeing a core set of, I think, large institutional investors in the vanguard looking towards whole portfolio analysis. What does it mean to take large environmental and social macro trends and long-term time horizons, and a better understanding of who the beneficiaries are of your funds? If you're, say, a retirement fund, what do beneficiaries really need? How do you take these into account and in your day-to-day investment practice, and what will that mean for your portfolio? Part of this is looking across asset classes. People tended to start with public equities, but now they've turned to private equity and real estate in particular. Real estate's a great space to think about these issues because of the tangible impacts of the built environment. But they're also thinking, at an even higher level about how assets can be allocated, what it means to engage in commodities future trading. Beyond those levels of practice, I think there's another, and this is a sort of narrowing group here, but those of us who are in the sort of thinking through responsible investment space are trying to come up with a more coherent vision of how investment activity is tied to the real economy. And in particular, how much over the long term we can expect a large institutional investor like a pension fund to achieve returns that are not tied to global economic growth. I think among the more powerful theories that have entered this community is the theory of the universal investor, the idea that if you're large enough, you own the whole economy, and the costs you externalize on one hand will be internalized on the other. And you can't really assume that you're going to achieve some alpha that will exceed what the real economy can produce. And I think that's, coming from the shock of the crisis, it used to be everybody thought they would be, gain alpha through ESG. And I think now the larger investors are looking more and more to figure out how to bring stable returns that meet their obligations to their beneficiaries, without chasing investment strategies that may prove beneficial over a couple of years but will blow up over the long term because they promise more than they can deliver systemically.
David, could you explain real economy just for the audience? what you mean by that, just as
yeah,
a term.
sure. And I'm using the idea of the real economy very loosely, but economic activity that takes place in the world that leads to productive economic growth, that leads to job creation, that leads to production of goods and services. Financial intermediation should be at the service of the creation of those goods and services, and often is. However, it isn't necessarily, I think, is one of the fundamental, if often unspoken, theoretical groundings of responsible investment. There is an idea that things can go off the rails, and I think the world has opened up to the idea that asset bubbles actually happen. We don't have to worry about the idea that markets are perfectly efficient anymore, but we still have to think a great deal about what it means to have real and sustainable economic activity.
Asset bubbles, another interesting term. Do you want to explain that one too?
Well, in the U.S. we had a great deal of investment in residential properties, which was undertaken on the assumption that somebody else was going to buy that property at an inflated price. People were gambling on people were making unidirectional bets on the ever-increasing price of houses that were unmoored towards any long-term real value that the house would have in a market.
Yeah, no,
it's pretty straightforward after the fact. But during the bubble, it was hard for people not to take out very large loans to buy houses because they were sure they were going to gain 10-12% every year, and for a while they did.
Now, just for an obstacle and an opportunity.
An obstacle to responsible investment, I think we have a systemic failure. People try to manage risks within their portfolios, but the systemic risk that's created through investment activity is still a huge barrier. That's one. The other barrier is the measurement of success. What does it mean to actually be a successful investor? Right now, its returns against a benchmark, which is generated, again, as I said, rather independently of the end use of what the investment should create. The opportunities, is tough to say that the crisis has created an opportunity. Everyone likes to say it. We've seen, I think, an opening to the idea that investors need to think about more than the next 3 months on their balance sheet. And I think especially at the level of the large institutional investors, there's at least potentially an emerging sense that if they're in the market for the long haul, they can't manage away systemic risk, and therefore they have to engage collaboratively on a way to build systemic risk management into the system. We'll see if they're successful. It's going to be a long haul, but at least they're starting.
David, thank you very much. Is there anything else you want to say?
No, thanks very much. Appreciate to speak.